In today's video, we delve into the essential topic of understanding real estate terminology and mortgages, which is crucial for anyone considering buying a home. Grasping these terms is not just a matter of vocabulary. It plays a significant role in making informed decisions during one of the most substantial financial commitments of your life. Purchasing a home is a major life decision that can impact your financial future for years to come. Therefore, having a solid understanding of real estate language can empower you to navigate the complexities of the housing market with confidence. As we explore this topic, we will highlight key mortgage concepts that every prospective homebuyer should know, from interest rates to loan types, and provide practical tips to help you make the best choices. By familiarizing yourself with these terms and concepts, you can avoid common pitfalls and ensure that you are well prepared for the home buying process. Join us as we break down these important elements, equipping you with the knowledge needed to embark on your journey toward homeownership successfully. Understanding these fundamentals will not only enhance your confidence, but also help you secure the best possible deal for your future home. A mortgage is fundamentally defined as a loan specifically designed for purchasing a home, allowing buyers to finance their property over an extended period. This financial tool is significant in the home buying process, as it enables individuals to acquire real estate without needing to pay the full purchase price up front. When you take out a mortgage, you enter into a debt agreement with a lender, which can impact your financial freedom. Understanding this relationship is crucial, as it highlights the responsibilities that come with borrowing money to buy a home. Mortgages typically require regular monthly payments, which include both principal and interest, and failing to meet these obligations can lead to serious consequences, including foreclosure. There are various types of mortgages available, each with its own implications for buyers. Fixed-rate mortgages offer stability with consistent payments, while adjustable-rate mortgages can provide lower initial rates, but may fluctuate over time. Additionally, government-backed loans such as FHA or VA loans cater to specific buyer needs. By understanding these different mortgage types and their effects on your financial situation, you can make informed decisions that align with your long-term goals in home ownership. When it comes to budgeting for housing costs, a common guideline is the 25% rule, which suggests that no more than 25% of your gross monthly income should be allocated to housing expenses, including your mortgage payment and insurance. This rule helps ensure that you maintain a healthy balance between your housing costs and other essential expenses, such as utilities, groceries, and savings. Adhering to this guideline can prevent financial strain and promote overall financial stability. It's crucial to remember that while housing is a significant expense, it shouldn't overshadow other financial responsibilities. To effectively calculate your monthly mortgage payments, consider using a mortgage calculator, which can help you estimate your monthly costs based on the loan amount, interest rate, and loan term. Additionally, factor in property taxes and homeowners insurance, as these can significantly impact your total housing costs. By understanding how much of your income should go toward housing, you can make informed decisions that align with your financial goals. This approach not only aids in budgeting, but also ensures that you can comfortably manage your overall financial obligations while enjoying the benefits of homeownership. When it comes to selecting a mortgage loan, a 15-year fixed-rate mortgage is often recommended as a preferred option for homebuyers. This type of mortgage allows you to pay off your home in half the time of a traditional 30-year mortgage, which can lead to significant savings on interest over the life of the loan. Typically, 15-year mortgages come with lower interest rates compared to their 30-year counterparts, making them an attractive choice for those looking to minimize their overall borrowing costs. While the monthly payments on a 15-year mortgage may be higher, the long-term financial benefits can outweigh the initial expense. By paying off your mortgage sooner, you can achieve greater financial freedom and reduce the amount of interest paid over time. It's essential for homebuyers to consider their long-term financial health when choosing a mortgage. Opting for a shorter loan term can lead to increased equity in your home and a quicker path to ownership. Ultimately, selecting the right mortgage type should align with your financial goals and lifestyle, ensuring that you make a sound investment in your future while enjoying the benefits of homeownership. Determining when you are ready to purchase a home involves recognizing several key signs that indicate financial preparedness. One of the most important factors is being debt-free, or at least managing your debts effectively. High levels of debt can hinder your ability to secure a mortgage, and may lead to financial strain once you take on additional housing costs. Additionally, having a fully funded emergency fund is crucial before entering the housing market. This fund should ideally cover 3 to 6 months' worth of living expenses, providing a safety net for unexpected costs that may arise after purchasing a home. It ensures that you can handle emergencies without jeopardizing your mortgage payments or financial stability. Furthermore, assessing your overall financial stability is essential. This includes evaluating your income, job security, and credit score, as these factors play a significant role in your ability to obtain favorable mortgage terms. By taking the time to ensure you are debt-free, have a robust emergency fund, and possess a stable financial foundation, you can confidently enter the housing market. This preparation not only enhances your home buying experience, but also sets you up for long-term success as a homeowner. Saving for a down payment is a crucial step in the home buying process, especially for first-time homebuyers. It is generally recommended to save at least 5% of the home's purchase price as a down payment. This initial investment not only demonstrates your commitment to the purchase, but also significantly impacts your mortgage terms and monthly payments. A larger down payment can lead to lower interest rates, reducing the overall cost of the loan and resulting in more manageable monthly payments. Additionally, putting down a substantial amount can help you avoid private mortgage insurance, PMI, which is often required for loans with smaller down payments. This can further enhance your financial situation by lowering your monthly expenses. Therefore, it's essential to plan and budget effectively for your down payment. Start by setting a savings goal based on your target home price and timeline for purchasing. Consider creating a dedicated savings account to track your progress and make regular contributions. By prioritizing your down payment savings, you can position yourself for a smoother home buying experience and set the foundation for long-term financial stability as a homeowner. Taking these steps will empower you to make informed decisions and achieve your dream of homeownership. Understanding the various costs included in a mortgage payment is essential for prospective homebuyers. A typical mortgage payment consists of several key components: principal, interest, property taxes, and homeowner's insurance. The principal is the portion of the payment that goes toward reducing the loan balance, while the interest is the cost of borrowing the money, calculated as a percentage of the remaining loan amount. Together, these two elements form the core of your monthly mortgage payment. In addition to principal and interest, property taxes are often included in your monthly payment. These taxes are assessed by local governments and can vary based on the property's value and location. Homeowners insurance is another critical component, providing financial protection against damages to your home and personal property. For buyers who make a down payment of less than 20%, private mortgage insurance, PMI, may also be required. PMI protects the lender in case of default and adds an additional cost to your monthly payment. Understanding these components is vital for budgeting effectively and ensuring that you can comfortably manage your mortgage payments while maintaining financial stability as a homeowner. When purchasing a home, it's crucial to recognize that the costs associated with homeownership extend beyond the monthly mortgage payment. Several additional expenses are not included in your mortgage payment, and being aware of these can help you budget more effectively. For instance, Homeowners Association (HOA) fees may apply if you live in a community governed by an HOA, covering amenities and maintenance of common areas. Utilities, such as electricity, water, gas, and internet, are ongoing costs that can vary significantly based on usage and location. Additionally, maintenance costs are an essential consideration. As a homeowner, you are responsible for repairs and upkeep, which can include everything from lawn care to fixing appliances. Emphasizing the importance of budgeting for these extra costs is vital for prospective buyers. Failing to account for these expenses can lead to financial strain and unexpected challenges. Therefore, it's essential to prepare for the financial responsibilities of homeownership by creating a comprehensive budget that includes all potential costs. By doing so, you can ensure that you are not only ready to manage your mortgage payments, but also equipped to handle the various expenses that come with maintaining your new home, ultimately leading to a more successful homeownership experience. Managing mortgage payments effectively is crucial for maintaining financial stability as a homeowner. One valuable resource for buyers is the Ramsey Mortgage Calculator, which helps you estimate your monthly payments based on various loan amounts, interest rates, and terms. This tool can provide clarity on what you can afford and assist in budgeting for your mortgage. Additionally, it's essential to explore refinancing options, especially if interest rates drop. Refinancing can lower your mortgage rate, potentially reducing your monthly payments and saving you money over the life of the loan. Another effective strategy for managing your mortgage is to consider ways to pay off your mortgage early. Making extra payments toward the principal, even if it's just a small amount each month, can significantly reduce the total interest paid over time. Additionally, you might consider bi-weekly payment plans, which can help you make an extra payment each year without feeling the pinch of a larger monthly payment. By implementing these tips and utilizing available tools, you can take control of your mortgage payments, ultimately leading to greater financial freedom and a quicker path to homeownership success. Being proactive in managing your mortgage can make a substantial difference in your overall financial health. In this video, we've highlighted the critical importance of understanding mortgage terms and budgeting effectively for homeownership. Grasping these concepts is essential for making informed decisions and navigating the complexities of the housing market. We discussed how being financially prepared before buying a home can lead to a smoother purchasing process and long-term success as a homeowner. From saving for a down payment to recognizing the various costs associated with mortgage payments, each step plays a vital role in ensuring you are ready for this significant investment. We also explored tools like the Ramsey Mortgage Calculator and strategies for managing mortgage payments effectively, including refinancing options and early payoff techniques. By taking these proactive steps, you can enhance your financial stability and enjoy the benefits of homeownership without unnecessary stress. If you found this information valuable, we encourage you to engage with our content by subscribing to our channel, liking this video, and sharing it with others who may benefit from it. Thank you for watching, and we look forward to seeing you in our next video.